Julian Emanuel, BTIG Chief Equity and Derivatives Strategist, joins us now. Julian, how are you playing a day like today?
So our view for the last number of weeks is basically you want to stay with value as a long-term theme, but we really turn defensive, stressing the defensive parts of value, healthcare, REITs, which we think are a tremendous inflation hedge and actually do just fine if the yield curve continues to flatten from here. But ultimately, we think that in an environment where you're going to grow GDP at 7% this year and over 3% next year, that value will resume that long-term outperformance. But what people fail to remember, and going back to April 2020, is that inherently value stocks are more volatile. And that's what we're seeing.
Okay, so you're buying straddles. You're expecting that volatility. How's that working out? How's the V? Is it working out? Which side of the V are you kind of seeing some action here? What kind of positions are you taking?
Well, certainly it's worked if you look at essentially 2 o'clock and 30 seconds back on Wednesday, when the market realized that the tapering debate was not only in play, but as we understand this morning, is perhaps even more intense, given Bullard's comments, than we expected it was, which opens up the idea that the Fed's conviction on inflation being transitory may not be exactly what Chairman Powell has been stating that it is in recent weeks. So for us, essentially, what it means is with the VIX trading down to 16, 15 at the beginning of the week, and looking at the importance of the July 28th Fed meeting now, which was going to be sleepy but is now momentous, optionality is very, very valuable, and we think continues to work.
Hey, Julian, do you think the move in yields is overdone? I mean, we're not dealing with like a deflationary environment or anything. I mean, it's still inflationary, even if it's transitory. I mean, maybe they're going to put the cap on it a little sooner than everyone thought. But are we justified in this move in yields? And how much more is there to go? And then how that filters out?
Well, we think the move is justified. Actually, to us, the biggest thing was on Wednesday and Thursday, seeing the 2-year yield sort of break out of that flat line above 20 basis points. And I mean, honestly, when you look at the Fed's dots, it's pretty inconceivable how 2-year yields could stay in the neighborhood of 20 basis points for much longer. But that has had the effect thus far of dampening and actually causing 10-year yields to come in. We don't think that persists for very much longer, simply because it is not entirely clear how aggressive the Fed is going to be with regard to inflation and tapering, and how successful that outcome is going to be.
Julian, what do you think is going to happen here? Bullard wasn't sent out to say these things by accident today. Is your expectation that 2022 is actually a bigger possibility in terms of rate hikes than people had imagined? Certainly, I've heard more of that conversation over the last few hours. Bullard certainly setting the table for that narrative. We talked about it on the show yesterday as well. If we're starting to bring forward, once the Fed starts, it does tend to come forward a little bit. If we're talking 2022, how much more adjustment is there to go?
Well, it could be considerable depending on what the data looks like over the next several weeks. Part of the reason that the 10-year yield has come in recently is that, on the one hand, all the inflation data is running hotter than forecast, but simultaneously, you look at yesterday's weekly jobless claims running weaker than forecast, and that combination keeps things in check. But if inflation continues to run hot, and Bullard has served as the advanced voice for Powell on a number of occasions the last several years, they could be forced to act sooner. But what they want to be doing is being cognizant of the fact that they don't want to act in a jump function. So get ahead of it now while the economy is growing at 7%, and you have the leeway to do so.
Yeah. Hey, Julian, you buying gold right now?
We are. To us, it's understandable. The commodity sell-off is another one of those areas. Alex, you and I have talked about this on a number of occasions. We turned bullish on energy shares when West Texas printed -40 over a year ago. And to us, it is very, very cyclical. It's very volatile. And this is the kind of weakness when we have a cyclical, globally coordinated growth paradigm in front of us for the next several years, that assets like gold will do well.
What do you think is going to happen to the dollar, given that?
So the dollar is roughly been range bound, okay, and I think part of the reason that you've seen this rally, is a lot of macro positioning. People have been very short the dollar, understandably so. We think longer term the dollar does go weaker because inflation is an issue and because other central banks will likely be tightening in concert with the Fed. I think that's part of the pressure we're seeing now from places like the Bank of Canada, the ECB's verbiage. And so ultimately to us, if we're going to grow globally and the virus is going to improve globally, we're already making fantastic progress, as we know in the US, that's a recipe for a weaker dollar longer term.